Hello, YouTube. Today we're going to be talking about whether or not we have a trap or we have a Fed put. The trap means we're going to go down. The Fed put means we're going to go up. A lot of people seem confused over the weekend when we did the weekend deep dive when we were talking about the Fed put. So I'm going to take a minute here to explain what that means, and then we're going to talk about whether or not we have a trap or we have a potential reversal on our hands. The Fed put is pretty much when the Fed pivots. Right now they are hawkish, which means that they're trying to tighten monetary policy. They're trying to make stocks go down, to put it simply. If they pivot or we get a Fed put, it means that they're going to stop hurting stocks and they're going to start making them go back up. And this is so important because the Fed put is at the 200 weekly moving average. And when we look here, that is what I have highlighted. It's the black line. The black line is going to correspond with the black number at 350.55. We got really close to it. Didn't quite hit it though. And that would be the Fed put. So again, when we go back to previous times where we went down more than 20%, 2018, 2016, 2011, 1990, and 1987, when we go back in time, we can note that every time we hit the 200 weekly moving average or the black line, and we hit it and bounce off, that's going to signal whether or not we actually are getting the put. So going back to here, 2016, hit the black line, starts a big expansion. 2018, hits the black line, starts a big expansion. Going back to 2011, you guessed it, hits the black line, starts a huge expansion. Where we did not do it is going back here to 2008 and 2000, which we reviewed on the weekend. I encourage you to watch that if you want to know more. So here the difference is that we did hit the 200, but then we fail to get back above the 50 weekly moving average. So same thing over here. We hit the black line, and when we get back above it, where do we stall out or stop going up? Right here on the 50 MA. So if we're going to be getting that Fed put, what it pretty much tells us is that we cannot afford to go down. We also have to break back above our 50 weekly moving average. That is how we can avoid a negative 50%, which came in 2000 and 2008. So again, very simply, the Fed put means that if we hear dovish commentary from Jerome Powell, or in pretty much saying that I think the market has done enough work to discount or to price in what we are likely going to be doing, we should only be going up from here. We got a higher high and a higher low so far. We should not be looking back. What would be the catalyst? The catalyst would be likely on Wednesday when Jerome Powell is going to speak. We have consumer confidence coming out tomorrow at 10 a.m., GDP revision coming out on Wednesday, and this one for Powell on Wednesday is so important. And the reason why is because he's going to be out here talking to his buddies. Again, Jerome shares his troubles with Lagarde and Bailey, Eco Week. Central bankers will appear together at ECB's Central Retreat. So this is important because they're all facing their own issues. And as they're all facing their own issues, if this is close enough to our test of the 200 weekly, I personally don't think it is, we should not be looking back from here. Where should we go? We should go from right here all the way up to as high as the blue line. And the blue line corresponds with 438.57. This number here is so important because when we get to 432, that is going to be where we actually exit correction territory, where we are 10% off the highs. So if we can get back above 432, that could be the birth of a new bull market if we get back above the blue line. Again, making it very simple here. Hit the black line, get back above the blue line, go up big. Hit the black line, get back above the blue line, go up big. Hit the black line, get back above the blue line, go up big. When we hit the black line and don't get back above the blue line, like in 2008 or 2000, we just dive down for 50%. So that is the Fed put. Now let's talk about the trap. So the trap here would be that people think, oh, well, we've been going down for so many weeks in a row, we're due for a bounce. I'm noticing a pattern here which is very hard for me to ignore, as I'm looking here with clean eyes. What I'm looking at here is going to be the yellow box. We're looking at the yellow box, and same thing we have here. So the reason why I could see this being a trap is because we set the week up very similarly, where we what? Again, we have a massive pump week, right? Huge week. And then we put in a higher high and a higher low, but a spinning top. Here we have what? Massive week, right? We gap up just like we did here. And now we are unsure where we're going to go. So for me, this could be a trap if we hover around here for the bulk of the week, or what? Into the end of the month and the end of the quarter, which would be Thursday. And then we go down after. What could be the catalyst? European CPI on Friday, ISM manufacturing after, or as we look forward to the following week, we got payroll Friday, next Friday, we got CPI, earnings season kicking off, and then the FOMC. So that is how we could have a trap where people think, oh my God, it's time to get back in bull. We're going back up. Time to get in. And we are having a little bit less fear actually shake out here. 2 points more in terms of fear than we had on Friday. So when we keep that in mind, this seems pretty simple. We're either going to close above the current area, or we're going to come back down to roughly 350.54. That is my line in the sand. And the reason why that 380 is my line in the sand is because when we look here at the monthly chart, what it tells us is that if we lose 380.54, we are going to be below our May monthly low. And that is not good because what? Well, again, we're closing below the monthly low. So that is a lower high, lower low, and closing below the low, which means it's going to be resistance. So we have to maintain this area if the bulls are in control. And we've been oversold for quite some time. So if these bulls are finally going to not just dead cat bounce, but actually reverse the chart, they can't afford to really stall out here. They have to make us go up. And I'll tell you the reason why. The reason why is because the S&P hasn't had such a bad first half of the year since the Nixon era. That's right, since the 1970s. So U.S. benchmark index is set for the worst first half since 1970. If this is it, and we're due for some relief, I'm talking real relief, we should be going only up from here. Stocks only go up. What's really important for us to remind ourselves as well is that, are we actually in bear market territory for the big stocks? Yes. Apple, bear market, -20. Microsoft, -21. Google, -20. Amazon, -32. Tesla, -30. So all of the biggest blocks are all in correction territory, bear market. So this is how the trap could be getting set up. So what I did on the weekend is we talked about the scenario for us to be going up or down into the first half of the week. And now I'm going to provide an update. And let me know in the comment section if you like these videos. I'm trying to do something a little bit new as we are evolving the channel. So now we're going to actually change this 380.54 area to be green because, well, we're above it. What's really important for moi just then is this. We're looking here over at our gap, which is going to be our yellow box. And we note that the low here is 389.75. Where are we right now? We're below it. So for tomorrow, that should be resistance if we can't reclaim it here in after hours, which we're trying to do. So if we can't gap back above 390, basically, I think that might act as resistance for tomorrow. If we can get back above it, what should it be? It should be support. We should maintain this area and put in another higher high and another higher low. If it's going to be a trap, I would expect that we print a lower daily low tomorrow or lose 387.4. And where could we go? Well, we could come back down to our previous top here on June 15th at about 372. So, sorry, 383. My apologies, 383. If that area cannot hold, then I'm looking for 350.54, which is going to be our monthly low. And pretty much if we can't hold this area, the bulls are not in control. So we also note that we're selling off on low volume because no one's really fighting this move. So it looks like it's pretty good. We have to also note that if we do start going down, we have 1 and 2 more holes to fill. This left us with an island at the bottom here because we have a double gap and the 2 days are below. So this is now looking like, oh, wow, this looks like it's really important where we're going to go. If we're going to start making it inside of this gap area, where do we have to get to? Well, we pretty much have to print a higher daily high, build up more pressure as we get closer to those catalysts I mentioned before. So that's pretty much it. It's not overly complicated. We also have to remind ourselves that we have 3 more days now that Monday's over with OPEX this week. So let's quickly check in on our options chain and see if there is any evidence that these guys are bullish or are bearish. So first of all, let's look at what happened today. So this is what happened today. We can note that they closed us here at 389.2. What happened? These got paid. These got a couple, actually, those didn't get paid because we closed at 388. So everything from here got burnt. And then we look on the call side, everything got burnt. So the option sellers were in full control today. Really impressive. So what I'm actually going to skip forward to, we're going to look at Wednesday now. And for Wednesday, again, what we're looking for here is going to be continuation as to whether or not people are already positioned for an up move or a down move. First thing that sticks out is that there is continuation here at 390 to 395. It actually goes all the way up to 400, but because we're only looking at the 16s, I'm only going to include what is most likely to pay out. So again, 390 to 400 is really where it starts to get spicy. On the bear side, we got 388 to 385. All right, now is there continuation to our quarterly expiry, which is going to be the spicy one coming in on the 30th. Let's have a look here. All right, we got it. So we're looking for June 30th, which will be the last calendar day of the month. That'll be the 16th. And what do we got here? Exciting. Why? If you're bullish, again, this just tells us that there is motivation for us to go where? Well, above 390, up to 395, and roughly the same open interest in volume is up at 400, which means we could go to ultimately fill all those gaps. As a reminder, we're looking for a gap fill up here to roughly 4015. So if we look at the premium attached, and I'm actually going to go beyond the 16s because I'm personally curious, because I want to see how much premium is attached to those 400 calls for the expiry. All right, so I'll show you what I see here. Oh, wow, they're actually even going higher. All right, so same expiry here. Now we're going to be looking at 400. So here they're worth about $1, right? Open interest is worth about $1 because they lost about 40 cents. They were worth $1 overnight. And it actually goes up here to about 405, but not really huge. So I would note that we could go as high as 400. We could fill all those gaps by Friday. So it's definitely possible we go there. On the flip side, when we look at the put side, I believe it was 380 where we have that fat stack and where it starts to get, again, a lot more bearish. So that 380.54 that we just pointed out becomes very important when we ask ourselves whether or not people are positioned for us to close the month out below 380. Answer is yes. So when we look here, we note that there's 100,000 in open interest at 380, 20,000 in volume, and it looks like there's a similar pattern happening here because we have volume at 385 with open interest, and the open interest is really big here as we start going lower. So these 380s will only pay out if we close below 380, which means this pattern's going to break bearish. We're going to be below this area right here, or 380.54. They get their money back at 379, or a gap fill back to our 23rd of June high. So that's really, really, really important. Why? Because there's a lot of money tied up here. It's a quarterly expiry. And now as we look forward to June 1st, I just want to see whether or not there's anything else here that tells us that we need to be a little bit mindful of the risk, or if we should just be looking for blast off. So I think I can actually get this whole thing in here, and this will actually be really good for us. Here we go. All right, here we go. So this is going to be for Friday, which will be after the 1st or July 1st, right? The first calendar day of the month. All right, is there a continuation? Yes, sir. So we got 390, 395, and then 400 with what? Open interest and volume. So it means that the bulls want us to be where? Above all of the resistance. They think we're going to be higher into Thursday and then have continuation into Thursday, then continuation to Friday. On the bear side, they're building a position here, right? They got 385 and we got 380 with open interest at 380. It looks like the bulls are actually a little bit more motivated for Friday. And this is going to be particularly interesting for me. With that said, I wish you guys all the best of luck tomorrow. And if you want to find out more, the video that queues up here in a moment will walk you through my entire weekend prep. So if you want to know more, I encourage you to watch that. If not, I look forward to seeing you tomorrow. And I wish you all the best of luck. Thank you for watching.